Imagine two coworkers walking out of the same office on the same Friday afternoon, same age, same salary, same city, same tax bracket, same savings account balance. They both just got promoted, and now each earns exactly $95,000 a year. They both decide it's finally time to become serious about building wealth. Ryan looks at his paycheck and says, "Now I can finally save enough money." Daniel looks at the exact same paycheck and says, "Saving isn't enough anymore. It's time to invest." 5 years later, both of them are convinced they made the smarter decision. Ryan is proud because his savings account has never been larger. Daniel is proud because his investments have been climbing despite some scary drops along the way. They're both confident. They're both telling friends they've figured out the secret. And they're both missing something that changes the entire picture. Because there's a salary where saving more gradually stops doing the heavy lifting, and investing quietly starts taking over. The size of that difference isn't what most people expect. In fact, by the end of this comparison, the gap between these two decisions is likely to be much larger than either Ryan or Daniel imagined. The important part is, this comparison is fair. Same age, 35 years old. Same city, Dallas. Same starting savings of $30,000. Same $95,000 annual salary. Same monthly living expenses. The only thing that changes is what they do with the extra money after the promotion. Both men receive roughly the same take-home pay after taxes and deductions. Their promotion gives each an additional $1,500 per month that isn't already committed to bills. Ryan decides certainty matters most. Every month he transfers the full $1,500 into a high-yield savings account, earning 4% annually. No market risk, no surprises. His money is available whenever he wants it. Daniel takes a different path. He keeps a 6-month emergency fund in cash, then invests the remaining $1,500 every month into a broad U.S. stock market index fund with an expected long-term annual return of about 9% before inflation. He knows some years will be negative. Some years could be painful. But he's buying consistently every month. Immediately, Ryan feels better. His account balance grows every single month. No red numbers, no headlines making him nervous. Every statement tells him he's richer than last month. Daniel has a different emotional experience. Some months his account rises by thousands of dollars. Other months it drops so much that it looks like several months of contributions disappeared overnight. His balance moves around constantly. One path feels responsible, the other feels uncomfortable. Feelings and math are two very different things. Let's actually run the numbers. On day one, both still have the same $30,000 emergency reserve. Ryan simply adds every extra dollar to savings. Daniel leaves $30,000 untouched as emergency cash and starts investing new contributions immediately. After 1 year, Ryan has deposited $18,000 into savings. With roughly 4% annual interest, his new contributions plus interest total about $18,400. Add his original emergency fund earning the same rate, and his total cash reaches approximately $49,600. Nothing exciting happened. Nothing scary happened. Everything worked exactly as planned. Daniel contributes the same $18,000 into his index fund, assuming a long-term average return, recognizing markets never move in a straight line. His investment account ends around $18,900. His emergency fund has also earned around 4%, bringing his cash reserve close to $31,200. Total wealth? Just over $50,000, only a few $100s ahead of Ryan. Hardly life-changing. In fact, if the market happened to fall during that first year, Daniel could easily appear to be behind despite making the mathematically stronger long-term decision. That's where many people quit. Not because the math changed, because their emotions did. Year 3 is where things start becoming interesting. Ryan has now contributed $54,000 over 3 years. Combined with interest, his total wealth grows to roughly $89,000. Predictable. Safe. Always increasing. Daniel contributes the exact same $54,000. Assuming average long-term returns, his investment account reaches approximately $62,000, while his emergency savings climb to about $33,700. Combined wealth? Just under $96,000. The difference is still modest, around $7,000. Most people looking at these two accounts would probably shrug and say, that doesn't seem worth the extra risk. That's because compounding hasn't really started doing its job yet. Early investing doesn't look impressive. It looks ordinary. The first several years aren't powered by investment gains. They're powered by contributions. The investments are still too small for returns to dominate. But something subtle is beginning. Ryan's interest this year is roughly $3,300. Daniel's investment growth alone is getting close to $5,000, depending on market performance. Notice what changed. Neither man worked additional hours. Neither received another promotion. Neither cut spending further. The money itself is beginning to contribute. That's the shift most people never notice. By year 5, Ryan has deposited a total of $90,000 beyond his original emergency fund. His total cash balance reaches approximately $133,000, assuming savings rates stay around 4%. Looks fantastic. Every dollar is available. Every dollar is protected within insurance limits if properly structured across institutions. He sleeps well. Daniel's picture looks very different. His emergency fund sits near $36,500. His investment portfolio has grown to roughly $113,000. Combined wealth approaches $149,500. Now the difference is over $16,000. Not because Daniel saved more. He didn't. Not because he earned more. He didn't. Because his investments earned approximately $23,000 while Ryan's interest earned closer to $13,000 over the same period. That extra $10,000 wasn't created by working harder. It came from allowing productive assets to grow. Now here's where people often make a mistake. They compare only account balances. They forget taxes. Ryan's interest income is generally taxable each year unless it's held inside certain tax-advantaged accounts. Depending on his federal tax bracket and state taxes, part of every year's interest disappears. On paper, that savings account earned about 4%. Sounds great until you subtract taxes. Daniel also faces taxes eventually, but long-term capital gains rates are often lower than ordinary income tax rates if investments are held long enough in taxable accounts. Inside retirement accounts, the tax picture changes again depending on account type. The details matter. The headline number doesn't. By year 7, something even more important happens. Ryan notices his annual interest has climbed above $5,000. He's thrilled. $5,000 without lifting a finger. Daniel checks his account. His portfolio has a reasonably average year and gains almost $13,000 before he even finishes adding that year's monthly contributions. Think about that. Ryan's money is working, Daniel's money is hiring more workers. That's a completely different engine. But this is also where investing becomes psychologically difficult. Imagine the market falls 20%. Daniel could temporarily watch more than $25,000 disappear from his account value. Not because he withdrew money, not because he made a mistake, because markets fluctuate. Ryan doesn't experience that his account simply keeps inching upward. So during market crashes, Ryan feels brilliant. Daniel feels foolish. Even if the long-term math hasn't changed at all. That's one of the strangest realities in personal finance. Sometimes the better long-term decision looks worse in the short term. And sometimes the safer-looking decision quietly becomes the more expensive one over decades. By the time both men approach the 10-year mark, the gap is no longer being driven primarily by what they're contributing every month. It's increasingly being driven by what the money they already accumulated is capable of earning on its own. As the 10th year arrives, Ryan has now contributed a total of $180,000 after the promotion. His high-yield savings account, assuming rates averaged around 4% over the decade, has grown to roughly $253,000, including his original emergency fund and accumulated interest. That's an impressive number. Over $250,000 sitting safely in cash. No volatility, no sleepless nights over market corrections, no wondering what tomorrow's opening bell might bring. Daniel reaches the same 10-year point. His emergency fund has gradually grown to about $44,000. His investment account, assuming a long-term average annual return close to 9%, reaches approximately $319,000. Combined wealth? Around $363,000. Now the difference is approximately $110,000. Notice something important. Ryan didn't make a mistake. Daniel didn't discover a magic investment. The gap exists because the money itself is now producing more money than either person's monthly contribution. That's the salary threshold most people never recognize. Early in your career, your paycheck builds your wealth. Later, your assets begin building it faster than your paycheck can. That's the transition. That's the moment investing starts doing more work than saving. But before anyone concludes that saving is useless, let's slow down. If I only showed you the upside of investing, I'd be doing exactly what every market influencer does. Real life is messier. Suppose the market experiences a major correction right after Daniel reaches that $319,000 portfolio. A decline of 30% would temporarily erase almost $96,000 on paper. Ryan experiences exactly $0 of market loss. His account statement barely changes. If Daniel panics and sells during that decline, he permanently locks in those losses. Ryan never faces that temptation. The investment only works if the investor does. That's why behavior often matters more than return assumptions. Now let's talk about the number everyone loves posting online, annual return. You'll constantly hear someone say they earn 12%, or 15%, or maybe 20%. Almost nobody talks about what actually stayed in their pocket. On paper, that's a fantastic return. Sounds great until you subtract everything else. Let's start with inflation. If inflation averages around 5% over long periods, a savings account earning 4% produces only about 1%. 5% real purchasing power growth before taxes. If inflation spikes higher, that advantage shrinks quickly. Your balance grows. Your buying power doesn't necessarily grow at the same pace. Now taxes. Interest earned in a regular savings account is generally taxed as ordinary income each year. If Ryan falls into a combined federal and state tax rate of roughly 24%, his effective after-tax return on a 4% account drops closer to about 3%. Daniel eventually owes taxes too if investing through a taxable brokerage account. But long-term capital gains are generally taxed differently than ordinary interest income, and taxes are usually deferred until investments are sold. Time itself becomes a tax advantage. Next comes expense ratios. Broad index funds aren't free. Fortunately, many cost almost nothing. A fund charging 0.03% annually removes only about $30 per year for every $100,000 invested. Tiny, but not zero. Then there's emotional cost. This one never appears on an account statement. Ryan never wonders whether tomorrow will erase 6 months of growth. Daniel absolutely does. That emotional pressure causes countless investors to sell at exactly the wrong time. According to Dalbar's long-running investor behavior studies, average investor returns have historically trailed market returns because many investors buy after prices rise and sell after prices fall. The market isn't always the biggest risk. Human behavior often is. Opportunity cost deserves its own conversation. Suppose inflation falls and interest rates drop. Ryan's savings account could decline from 4% to 2%. His strategy immediately produces less income. Daniel's portfolio may continue growing because corporate earnings continue growing over long periods despite changing interest rates. Neither outcome is guaranteed, but opportunity cost is real. Keeping every dollar in cash protects against market swings while exposing you to slower long-term growth. Now let's be fair to Ryan. There are situations where his strategy absolutely wins. If you're planning to buy a home within the next 2 years, keeping your down payment invested in stocks could be disastrous if markets decline right before closing. Cash wins. If you're building an emergency fund, liquidity matters far more than maximizing returns. Cash wins again. If you're approaching retirement and will need the money very soon, reducing volatility may be worth accepting lower expected returns. Again, cash can be the better decision. And here's another overlooked example. Someone carrying credit card debt at 24% interest shouldn't be debating whether to invest more. Eliminating that debt is mathematically equivalent to earning a guaranteed return equal to the interest avoided. That's difficult for almost any investment to beat. Now let's be equally fair to Daniel. Investing isn't automatically superior either. If your employer offers a retirement match and you ignore it because you're chasing speculative investments, you're potentially walking away from guaranteed compensation. If you invest money you'll need next year, you're mismatching your timeline. If you concentrate everything into a single company instead of diversifying, you're increasing risk dramatically without necessarily increasing expected return. Every strategy has conditions where it shines. Every strategy has conditions where it fails. Now let's zoom out another decade. 20 years after that promotion, Ryan has remained disciplined. Every month, no exceptions. His savings account has grown to approximately $585,000, assuming interest averaged near 4% throughout the period. That's remarkable discipline. Daniel follows the same monthly contribution schedule. His emergency reserve now sits around $66,000. His investment portfolio approaches approximately $1.07 million. Combined wealth, roughly $1.14 million. The difference has expanded to more than $500,000. Think about that carefully. Ryan saved every dollar he intended to save. Daniel saved exactly the same amount. The additional wealth wasn't created by earning a larger salary. It wasn't created through stock picking. It wasn't created through taking extraordinary risks. It was created because productive assets compounded for 20 years. Now here's the lever that changes everything. Suppose Daniel increased his monthly investment by just $200 after receiving another raise 5 years into the journey. Instead of investing $1,500 monthly, he gradually increased contributions to $1,700. Over the following 15 years, assuming similar long-term returns, that seemingly small adjustment could add well over $100,000 to his ending portfolio. Not because of the extra $200 itself, because every future dollar had years to compound. That's why early increases matter disproportionately. The numbers become even more interesting when we compare them against real-world data. The FDIC insures eligible deposits at member banks up to $250,000 per depositor, per insured bank, for each ownership category. That's a safety feature, not a wealth-building feature. It protects principal. It doesn't accelerate growth. Meanwhile, the historical long-term annualized return of the U.S. stock market, measured across broad indexes over many decades, has averaged roughly around 10% before inflation, although yearly returns vary dramatically and future performance is never guaranteed. Those are simply historical observations, nothing more, nothing less. So what's the practical playbook? First, build an emergency fund covering roughly 3 to 6 months of necessary expenses. That's your financial shock absorber. Second, eliminate high-interest consumer debt before aggressively investing. A guaranteed 20% interest avoided usually beats chasing uncertain returns. Third, once those foundations are in place, automate investing immediately after every paycheck instead of waiting until the end of the month. Automation removes emotion from the equation. Ryan and Daniel both walked away believing they made the smart play. Ryan believed certainty was the ultimate wealth strategy. Daniel believed investing alone solved every problem. Neither one actually ran the complete numbers at the beginning. Ryan underestimated what compounding productive assets could do over decades. Daniel could have underestimated the importance of liquidity, discipline, and staying invested during painful downturns. The real trap isn't saving. The real trap isn't investing. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. Because your salary doesn't magically make you wealthy. Your decisions determine when your money starts working harder than you do. And once that transition happens, every future dollar has a different job. If you're wondering what happens when you combine aggressive investing with tax optimization and employer retirement matching, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.